Okay, hello everyone, and welcome to this webinar brought to you by fxstreet.com. My name is James Chen. I am the Director of Technical Research and Education at FXDD. Now, I'd like to first apologize about last week, my not being able to make that webinar. I do apologize about that. I had some emergency issues that I had to take care of, but hopefully all of you that were registered for that are at this webinar, and I'm actually filling in today for my colleague, Greg Michalowski. So it worked out pretty well. So anyway, I would like to talk today, as I always do, about my way of looking at the markets and my perspective on looking at the Forex market in terms of the technicals and strategies, and my particular approach to looking at currencies and trading currencies. So with that, let's get started real quick. Before I get started, just a quick, first of all, today I will be talking about what I call T.P.B and the deep pullback. T.P.B is my general approach to trading in the Forex market. T.P.B stands for Trend Pullback Breakout, and I've talked about this on a couple of occasions. I don't think to the FX Street audience, but I have talked about T.P.B, which is my general approach, as well as a strategy that follows or conforms to the approach of T.P.B, which is called the deep pullback, which I call the deep pullback. So anyway, let's get started real quick with that topic, and I'm going to show you a bunch of charts as well. If you have any questions, please feel free to type them in to the window on your Hotcom browser. And let's get started. Before we get started, as always, just a quick risk disclaimer. Trading foreign exchange is a high-risk activity, and I'm just going to give you a few seconds to read through the rest of that, and then we'll move on. Hopefully you can see all my slides here. Okay, and also before I get started, just a quick, I haven't been here, in quite some time at FX Trade. I've been doing a lot of traveling I've been to China and was at the Vegas Traders Expo, and so I haven't been doing a lot of, in terms of webinars with FX Street lately. But in case you are not familiar with who I am or what I do, just a very brief introduction. My name again is James Chen. I am the Director of Technical Research and Education at FXDD. We are a global foreign exchange broker, and I have been with FXDD just for about 6 months, and prior to that I was at another foreign exchange broker. Now, I've been an active Forex trader and analyst since the inception of retail Forex, using primarily technical analysis, as many of you who know me already know. I've been trading equities and futures prior to the Forex market, but ever since the Forex market started, basically around 2000, 2001, where retail traders could participate, I've been trading almost exclusively in the Forex market, although I've also been looking at metals and other commodities as well. I am a Chartered Market Technician, or a CMT, and that is a designation for technical analysts, both here in the U.S. as well as abroad. And I am registered as a Commodity Trading Advisor, or CTA, here in the U.S. with the National Futures Association. I publish daily and intraday currency analysis that you'll be able to find at fxdd.com, as well as many other places, including on FX Street and the Forex Street blog. And I've also authored numerous articles in such publications as Forbes, Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, and SFO Magazine, and I've been quoted on a regular basis by Reuters News, Dow Jones, Bloomberg, Associated Press, and the National Herald Tribune, as well as many others. And I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, both of which the last couple of years were published by John Wiley & Sons. And I also have a high probability trend following in the Forex market DVD set that's put out by FX Street. So I'm very happy about that. And if you want any information on that, you can go to fxstreet.com, and there will be information on that. Okay, great. So that's enough about me. Now, very quickly, and I would like to talk about, as I mentioned, T.P.B, or Trend Pullback Breakout, which is my general approach to trading market. I have many, many strategies that I use, but for the most part, all of them conform to my general approach called T.P.B, trend pullback breakout, which I'm going to present today, as well as I'm going to show you a specific strategy that I use, one of my strategies that conforms very well to this general approach as well. So let's go over that real quick. Now, in terms of T.P.B, this is my key principle for trading. I trade, T is trend, P is pullback, B is breakout. So what I like to do is I like to identify the trend, I watch for a pullback, and I trade the breakout. Once again, identify the trend, watch for pullback, trade the breakout. Now, if you take a look here, what is the point of having this type of approach? Well, very simply, and I've been talking about this for years actually on FX Street and many other venues. In terms of, the fact that I'm a trend follower. So I like to follow the trend. I like to trade with the trend. So path of least resistance. So, number one, I'm looking for a trend. Number two, I'm waiting for a pullback. Why am I waiting for a pullback? Well, the fact is that, in any trend trading situation, the best possible place to get into that trend is not on in terms of, let's say, there's an uptrend, is not on a breakout above the high. Rather, it's a pullback after a pullback occurs, or recovery of a pullback occurs. Okay, so I'm looking for some type of a pullback. Why am I looking for a pullback? Well, that is the most cost efficient, the most cost effective way to get into any trend. Because if you think about it, if you're in an uptrending situation, let's say, and you have a pullback to the downside, okay, you're getting in at a cheaper price. You're getting in long at a cheaper price. And that is a cost effective place to go. And plus, that will also help with your risk to reward or reward to risk ratio if you get in at a lower price. By the same token, in a downtrending situation, you are looking for to get in at a higher price. So let's say price is downtrending. You're looking for a correction, a retracement, a pullback, wherever you want to call it, to the upside so you get in at a higher price, because essentially what you want to do when you're going short is you want to get in at a higher price and get out at a lower price. And that's where you get your profit. So I'm always looking for a pullback. Now, the third element to this is the breakout. Now, when I talk about breakout, there's oftentimes a lot of confusion. Now, some people say, are you looking for a breakout above the high of that trend? Well, not necessarily. What I'm looking for is some type of a breakout to show me or to give me some indication that the pullback is possibly recovering and price is going back in the direction of the trend. That breakout is giving me that indication. So does that mean that breakout is breaking out above the last high? In this case, if you see over here, I don't know if you could see my mouse right here, but a lot of people ask me, when you talk about breakout, are you talking about a breakout above that high? Okay. Well, no, that's not the best place to get in. What I'm usually talking about when I talk about breakout is I'm looking for after the pullback occurs and price turns back in the direction of the trend, then I'm looking for a breakout that's indicating to me some type of a resumption of the trend. Okay, giving me some indication or some hint of a resumption of the trend. And let me show to you on a real chart an illustration of that. But before I get to that, let me just finish this slide right here. Now, once you get in on this breakout, and you see this blue line right here, the short blue line as my breakout level, that's my entry level. Once you have an entry level, okay, and this is an uptrend, it could happen just as easily on a downtrend, but just for illustration purposes, I'm using an uptrend. So if you have a breakout above this blue line right here, okay, and I'll illustrate that in a second on my charts, but if you have a breakout above there, that is your entry level, and right away you could define your risk. How do you define your risk? Well, you put your stop loss, whether it's a hard stop loss or a mental stop loss, right below the low of that pullback. Okay, how do you know it's the low of the pullback? Well, once price turns and pivots on that low, then that's where you have the low of the pullback. And then you have the breakout level, which is your entry level, and then right away you can place your stop loss, and that is your defined risk. So right over here, I have this bracket here in red that talks about risk. That's your risk. And at that point, not only can you choose your stop loss, once you have your defined risk, then according to your reward to risk ratio, risk reward ratio, whatever you want to call it, you can set your reward. And preferably in a trend following situation, you want your reward to exceed your risk. So in this case, once you have defined risk, then you could define your reward as well, and that would be your profit target. So in green up here could be your profit target. It could be 2 times, it could be 3 times, it could be 2.5 times your risk or what have you. And you want to make sure that your reward is larger than your risk. Okay? So once again, number 1, I'm looking for a trend. I'll show you exactly how I do it. This is just the approach right now. I'm going to show you the specifics in a second. So the approach, you find the trend. Okay. Number 2, you look for a pullback. Number 3, you look for a breakout. That's giving you indication of a continuation of the trend after the pullback or recovery of the pullback. And then at that point, you have your defined risk. Once you have your defined risk, you could define your reward. And at that point, you can know both your reward and your risk, and you have very well-defined reward to risk ratio. Okay. So underlying all of this approach is risk control through stop loss. Now, a lot of people ask me, you talk about stop losses all the time. Are you talking about hard stop losses or mental stop losses or what? Well, usually I'm talking about hard stop losses. But for some reason or another, a lot of people do not like to place hard stop losses. You can place mental stop losses if you like. However, you must, if you choose to place mental stop losses, you must have the discipline to follow through on those stop losses. Okay? If you do not have the discipline to follow through on your mental stop loss, you might as well not even be trading. Okay? Or you place your hard stop losses. Okay? It's very, very simple, at least from my perspective. Okay? So underlying principle to this whole approach is risk control through stop loss, whether it's hard stop loss or mental stop loss with discipline. Okay, I've got a question here. What typically is your risk-reward ratio? Great question there. Risk-reward ratio, usually what I like to choose for this particular approach is anywhere between 1.5 to 3 times my risk. Okay, so reward is anywhere from 1.5 to 3 times my risk, depending upon how I am playing it. Now, when you talk about reward to risk, when you talk about positive expectancy in your trading, in any strategy that you're using, you have to balance your reward to risk ratio and your percentage win ratio. Okay, hopefully that makes some sense. Usually what I do, I don't think I have time today, but usually what I do is I like to talk about having a positive expectancy. And positive expectancy or creating a positive expectancy is not only about having a good strategy, it's about a good entry and exit strategy. It's all about balancing your reward to risk ratio and your percentage win ratio. If your reward to risk ratio is very high, let's say you're shooting for 4 to 1, 5 to 1 or more in terms of reward to risk, where your reward is 5 times, 4 times your risk. If you're shooting for a high reward to risk ratio there, necessarily your percentage win ratio will go down. Okay? And if you have a lower reward to risk ratio, let's say 1 to 1, 2 to 1, what have you, then your percentage win ratio should go up. So it's all about balancing your reward to risk ratio and your percentage win ratio. You put that together, and if you could balance it well, along with a good strategy, then you can have a positive expectancy. And a positive expectancy is what gives you consistent profitability. Okay, and the higher positive expectancy, the better. I don't think I have time to go through that today, but I will try to do that at some other point. And UCL Investment Society asked James, would it be possible to get a copy of your slides after the webinar? Absolutely. Please email me at jchen@fxdd.com. Again, jchen@fxdd.com. Be more than happy to provide you with these slides. Okay, so that's my key principle. Okay, so you want a smaller risk, larger reward, and this is my principle, T.P.B, trend, pullback, breakout. Underlying principle, risk control through stop loss. Okay, now, let's take a look at a real chart. If you take a look at this chart here, you could see that I've identified the trend. Okay, in this case, the trend is identified with this uptrend support line. In my deep pullback strategy that I'm going to show you in a second, it's using moving averages, but just to show you and illustrate my general approach of T.P.B, you have the trend first. Okay, the trend is up in this case, obviously, with this uptrend support line. Number 2, I'm watching for a pullback. Now, I've got two pullbacks here. Okay, I chose to illustrate this one right here. Okay, so you got a pullback. How do you know when this pullback ends? Well, you really don't know. A lot of people say, I'll look for a trend and I'll trade the pullback. And what does that mean? Are they looking for a pullback to a Fibonacci number? Are they looking for a pullback to 61.8% Fibonacci or the 38.2%? And then at that point, they're going to go long in that uptrend? Well, I don't subscribe to that because there needs to be a third factor here. And that third factor for me is a breakout, because how do you know that pullback will stop at the 38.2% or the 50% or the 61.8%? You simply do not know. It could turn into a reversal. It could turn into a consolidation. It could be anything. Okay, so I'm looking for another factor, and that factor is breakout. So first I have the uptrend, then I have the pullback. Okay, that pullback, I don't know it's ending until some type of price action is telling me that perhaps, giving me some indication that perhaps there will be a breakout. There will be a move to the upside. Okay, hopefully you guys could see everything here. Okay, Gamster asks, do you look for confluence of just a pullback on a fib is enough? No, I do not. Gamster, great question there. Am I looking for a confluence of just a pullback on a fib? No, I'm not. And for this particular strategy and approach right here, I'm not even using Fibonacci's. Okay, I just use that as an example to show that a lot of people will say I'm looking for a trend and I'm looking for a pullback to some Fibonacci number, and I'm gonna trade based upon that pullback. Well, you really don't know. So I'm looking for the third element here is trade the breakout, and this breakout can be a breakout above, as you can see here. This is an hourly chart of gold. It's a little bit hard to see, but you've got this thin blue line here that's moving down. That's a counter trend resistance line. I'm looking for a breakout to the upside above that. Okay, or it could be other types of breakouts. But once again, what I'm looking for is a trend, and then a pullback, and then some type of a breakout. Now, this breakout is telling me that perhaps that pullback has recovered. Perhaps there's going to be a move back in the direction of the trend. In this case, is to the upside. Okay, so once again, risk control through stop loss, and this is my key principle. Okay, if any questions about that, please let me know. Okay, so let's move on real quick. That's my key principle. Now let me talk about my strategy here. One of my strategies is called deep pullback, and this conforms very well to the T.P.B philosophy or approach to trading the markets. Now, when you talk about deep pullback, what is it exactly that I'm talking about here? Well, I'm looking for deep pullbacks. Why am I looking for deep pullbacks? Well, deep pullbacks give me a better place to enter into a trend. Now, some people may say a deep pullback could be a reversal, or a deep pullback could be the end of the trend. Yes, it could very well be. But I'm looking for deep pullbacks that ultimately continue in the direction of the trend. And how am I looking for that? Well, first of all, I'm looking for deep pullbacks. Why am I looking for that? Because I'm looking for the best places to get into the trade. As I mentioned before, in a trend trading situation, you're looking for the most cost-effective, cost-efficient entries into that trend. And what's the most cost-efficient, cost-effective entry to that trend? Well, it's on as low a price as possible, okay, in an uptrend. In a downtrend, you're looking for a deep pullback, which means as high a pullback as you can, because you're trying to get in at as high a price as you can, if there is a trend, and to go and ultimately close out your position at as low a price as you can. Okay, so that just makes a lot of sense. So deep pullbacks are good because you're getting in at cost-efficient places, cost-efficient locations, and therefore you can maximize your ultimate profit in terms of your exit. Okay, so hopefully that makes sense. Okay, so the strategy is called deep pullback. Let me explain it briefly, and then let's go to the charts. Okay, this is a 3 moving average pullback trade. Okay, I have 3 moving averages. Simple moving averages, 200, 150, and rest assured, I'm going to go to my charts in a second. 3 moving averages, 200, 150. Why am I using simple moving averages? I've been using them forever, and these are very common moving averages. And these, through a lot of testing and experience, these moving averages tend to work very well in this particular case. Okay, so 3 moving averages. I only trade with the trend when the 3 are in correct order, what I call COMA, correct order of moving averages, COMA, C-O-M-A. Funny name, but it makes a lot of sense. What is COMA? What is correct order of moving averages? In an uptrend, you have the longest moving average on the bottom followed progressively higher by shorter moving averages. That's an uptrend. So you have a 200 moving average on the bottom, and then above that is the 100-period moving average. Above that is the 50 moving average. I like to see separation between those moving averages and the correct order. In a downtrending situation, I'm looking for the 200-period moving average to be on top, and then the 100-period moving average to be underneath that, and the 50-period moving average to be underneath that. And that, for me, is a correct order of moving averages, or COMA, for a downtrend. Okay? So if they are crossed, if there's not correct order of moving averages, or if there's no separation between the moving averages, that is not a trend, and we do not trade in this particular strategy. We do not trade. Okay, now, once we have a correct order of moving averages, we enter only when the stochastics pullback coincides with the price pulling back to the 100 moving average or more. Now, when it pulls back to the 100 moving average or more, what does that represent to me? That represents a deep pullback. If it pulls back just to the 50-period moving average, that for me is a shallow pullback, and I'm not playing that in this particular strategy. So if it pulls back to 100 moving average, that to me is a deep pullback. And in an uptrend, if it pulls back to the 100-period moving average or lower, that for me is a signal. In a downtrend, if price action goes down and then it pulls back up to the 100-period moving average or higher, that for me is a deep enough pullback. And at that point, I'm going to look to pass into this trade. Now, not only should it hit the 100-period moving average or more, we should also see the stochastics crossing from overbought or oversold. I'm going to show you some of the charts in a second. It's just a little, maybe a little confusing right now on these slides. And then once we get into the trade, we place our stop loss at the last swing. Okay, whether it's below the last swing low in an uptrend or above the last swing high in a downtrend. What I like to do is target 2 to 3 times my stop loss, or 2 to 3 times my risk, or better. Okay, optionally, we could also trail our stop loss to lock in break even and further profits. Okay, let me show you the charts real quick. Okay, so this is a dollar Canada chart. Okay, now let me just show you the most obvious one, just to give you an example of what I'm talking about. Hopefully, you can all see my charts here. Okay. First of all, number one, in this deep pullback trade, I'm looking for correct order moving averages to denote trend. And in this case, I have the 200 period in blue. I've got the 100 period in sort of dark red. And I've got this 50 period in orange. Okay? So this is a correct order for an uptrend. A downtrend is simply the opposite. A downtrend is like so. 200 period on top, 100 below that, 50 below that. Okay? So let's just look at this first. The correct order in an uptrend. Once I have a correct order in an uptrend, and this is an hourly chart of dollar Canada, I tend to notice that this strategy tends to work better in hourly charts on all different currency pairs, but on hourly charts it tends to work very well. And I've got my stochastics down here in either 1433, 833, 533, what have you. Usually it's around 833, but it doesn't make a huge difference. Okay, so once we have the correct order moving averages as we have here, I'm looking for pullbacks to this 100 period, which is the red one here, the 100 period or more. When I say more, I mean lower in an uptrend. When I say more in a downtrend, I mean higher. Okay? Now, some people will ask me, if it goes in an uptrend, if it goes below the 200 period, will you still look to trade that? And my answer is yes. Okay, I'm looking for deep pullbacks, as deep as possible, as long as they're not, reversals. If they are reversals, then I've got my risk management to take care of that. Okay, so in this deep pullback trade, first of all, moving average. Correct order moving averages is my first element, trend. okay? Number 2, watch for pullback, and I'm looking for deep pullbacks. I'm looking for, in the case of an uptrend, I'm looking for a pullback to at least the 100-period simple moving average or lower in an uptrend, okay? Number 3, I'm looking for a breakout, and this breakout occurs when the slow stochastics breaks out, in this case in an uptrend, breaks out above oversold. Okay, oversold on the slow stochastics I have here as 20. Overbought is 80. So in an uptrend, you're looking for a cross above oversold, over the 20 line, a cross and close above the 20 line. Okay, and that would be a breakout for me, showing me that perhaps this pullback is recovering and moving back in the direction of the trend. Okay, so once you do that, okay, so here in this red box right here, I have price action. It moved down below. It was correct order moving averages. It moved down to more than the 100-period simple moving average, and then it crossed above oversold, crossed and closed above oversold on the slow stochastics. Once that occurs, I can get into a trade. After that close occurs, I can get into a trade. Now, at that point, I get into the trade, which is about here, if you can see my crosshairs. Okay, once I get into that trade, then at that point, immediately, you can place your stop loss below the last low. So you have defined risk right around here. Okay, so I got in around here. I put my stop loss right there. And stop loss is very, very important. Whether it's a hard stop loss or a mental stop loss, you need to have your stop loss there. Okay, so once you get in, then you get into a trade. Now, once you have defined risk, at that point, according to your risk-reward parameters, let's say 2 to 1, 2.5 to 1, 3 to 1, 1.5 to 1, whatever you want to use, whatever works best for you. I tend to use around 2 to 1, 2.5 to 1 or so. Okay, whatever works, because that balances with my percentage win ratio, which I hope I have time to talk about today, but I don't think so. So anyway, so you have your defined risk. Then you, according to your reward to risk ratio, you can set your reward. Okay, your profit target. And at that point, you could have both. Now, you could wait for your reward to risk ratio to be fulfilled, or you could move your stop loss to try to lock in profits as the trade goes in your direction. Either way, depending on what works best for you, you have a couple different options there. Okay, so as it moves up, you could hit your stop loss. So hopefully that makes sense there. This is dollar Canada hourly chart. Right now, as we can see to the right-hand side of the chart, we could see that there's really nothing, okay, because there is no correct order moving averages. We have the red line and the blue line at the same area, okay, so the moving average in the same area. So right now, this was not a trade, although I hear on the 30-minute chart that was actually a setup for this particular deep pullback trade. Anyway, so we take a look here. So a pullback, we have correct order moving averages, pullback to 100-period simple moving average or more, and then we have stochastics crossing up above oversold. At that point, you get in, you have your risk, and then you have a reward. Same thing over here. We have the correct order moving averages here with the blue line, and then the shorter moving average 100-period above that, and then the 50-period above that. We see the pullback. Okay, it pullbacks. It goes all the way below the 200-period. That's fine. And then we have a cross above the oversold, and at that point, a possibility for getting into a trade. And at that point, you could also set your risk and your reward, or you could trail your stop loss. Okay, back here, the cross moving averages. There's not much you could do there. Over here, before that, we see the same type of situation here. Correct order moving averages for an uptrend. Okay, then we see this. We see a pullback. It pulls back way below the 200-period moving average. That's fine. And then we have a cross right over here. Okay, a cross and close. You get into a trade. You could set your risk-reward parameters right there. Okay. Here's another one back here. Okay, and let me take a look here. Now, this might not have been a great trade. There is correct order moving averages right here, as you can see with my crosshairs. Okay, blue, red, and then orange up here. Okay, now it crosses up, but at that point it's a very big candle. Okay, but let's say you get into this trade. You get into this trade, it moves all the way back down. It does not take your stop loss out. Maybe it takes out your break-even trail, but nonetheless, it's a possibility. The direction is correct, but depending on how you manage this trade, it could be either a break-even. It could be it's either a break-even or a profit. Okay. Here we have here another one. Correct order moving averages. This is a downtrending situation. Okay. So we have it goes to the 100 period. Now, if you take a look here, let me just show you real quick. There are all these areas here that it pulls back. Okay. It pulls back, but it does not fulfill my criteria of going to the 100 period. So I'm not going to look at that. Okay. In this particular strategy, I'm not going to look at that. Okay, there are a bunch of questions here actually that I didn't see. Zebra sounds like the name of a Hollywood blockbuster. That's a great point there. Deep pullback. Okay, Len, James, do you prefer some consolidation at the pullback before the breakout? No, not necessarily. Although, okay, that's a great question, Len. Do you prefer some consolidation at the pullback before the breakout? Some consolidation at the pullback before the breakout is pretty good. What I don't like is on the breakout if there's a huge candle, because then that skews your risk-reward ratio. If there's a huge candle, let's say in an uptrend, it pulls back to the 100-period simple moving average, and then stochastics crosses above oversold. And then there's a huge candle that goes along with that. And then you get it on the trade. That skews your risk-reward ratio. So that's the only time I would say, in terms of this strategy, maybe we should stay away because the risk-reward is too skewed, for my liking. Okay, so that's one way that I might stay out of this trade. Jeno, is it similar to triple screen trading strategy? It's a little bit similar in that the approach is the same. The approach of T.P.B, of trend, pullback, breakout, yes. But this is only using one time frame. Okay, the similarity is clear, and it's the similarity between these two strategies and the triple screen or the triple time frame trading strategy that I often talk about. The reason I talk about all these types of strategies and there's some similarities between them is because my approach is the same, which is the T.P.B approach, the trend pullback breakout approach. And therefore, that's the type of trading that I do. Okay, so great point there. Zebra, I think banks use those. I'm not sure exactly what you mean by that, but I think, in terms of the general approach, it's a very common approach by traders. Will this work on JSIC? Will this work on 1 minute or 5 minute? I found that it works best on the hourly chart, but yeah, it could surely work on the 1 minute or 5 minute. I've tried all different time frames. For me, it tends to work on the 1 hour. Some people talk about 30-minute or even shorter time frames, but for me, I've done a lot of testing on this, a lot of trading on this, and usually I'm looking more at the hourly chart. Solomon, what is the importance of having all moving averages aligned? Once again, Solomon asks, what is the importance of having all the moving averages aligned? That's the correct order moving averages. That's just showing you that there's a trend. Okay, so number one is trend. You want to see that there is a trend, and having the correct order, and when you say all of the moving averages are aligned, having the correct order means that there's a trend. That's my first criteria. Second criteria is a pullback, is a deep pullback. Okay. Third criteria is a breakout. In this case, breakout of stochastics. Okay. Okay. All right. So, Boyke, I'm going to finish the presentation real quick, and then we'll get to any other questions you have. Okay. So that's the general situation there. Let me show you another. Let me show you. This is. Wait, let me just see here. Dollar Swiss. Okay, this is also an hourly chart of dollar Swiss. Same type of thing here. We got a downtrend. We got correct order for a downtrend. Okay, I'd like to show you others that some trades that don't work, but let me show you this one first. It's a downtrending situation. We have longest moving average 200 on top, followed by the 100 period below that, followed by the 50 period below that. Those moving averages are in line; they're in correct order. That's a downtrend. We see a pullback to beyond the 100 period. Okay, in this case, 100 period or more, a deep pullback means 100. In the downtrending situation, 100 period or more means 100 period or higher. So it's gone to 100 period or higher. Then we see that stochastics. This is the 833 in this case. It's in overbought, and then it crosses down below overbought. Once that occurs, I could go short on this trade. That short occurs right around here. Okay. Now, when that short occurs, okay, then I put my stop loss right above here. Now, a lot of people ask, where do you put your stop loss? Well, it will be right, in the downtrending situation, it will be right above the last, the pullback, right above the pullback. And what does right above mean? Well, it could mean, depending on the time frame you're using, it could mean like, 5 pips or 10 pips or what have you, or 3 pips or, in this particular case, usually I use around 5 pips, on the hourly chart. So 5 pips above the pullback here. Okay, I get in this trade, then you have to define risk. Once you have defined risk, you could define your reward, okay, according to your reward to risk ratio, or you could trail your stop losses, etc. So in this case, this was a very good trade here, okay, very good trade here. Okay, now here we have another one. Okay, this is a good one where it doesn't work so well. Now we have this turn here. It goes to the 100 period. Okay, and then it crosses. You get in around there. Okay, you put your stop loss there, and then you get stopped out, and it keeps going up, and then you see a bunch of crosses. Okay, here, then it turns back into correct order. Okay, correct order moving averages, and then we have a pullback all the way down to the 200 period, which is more than 100 period. Okay, we have a turn to the upside. We get in on that breakout above oversold. Okay, we get in on there, and we put our stop loss down here, and then we can define our risk reward, or we can trail our stop loss. Here we have the same. Okay, if you take a look here, okay, we have, okay, let's say right here, we have, everything lined up, correct order moving averages. It pulls back, and it crosses above oversold. However, did it go back to the 100 period or more? No, it did not. I'm ignoring that trade. Over here, same thing. Now, a lot of people ask me, well, how do I deal with this? Like, if it touches oversold, okay, and then bounces off there, is that the same as if it was in oversold and crosses? I would usually say yes, okay? So if it touches oversold and then bounces back up and closes, then that for me is also a potential trade in this strategy, okay? But you can do whatever you want to do. Now, if you see that bounce occur, okay, should I get into this trade? This would have been a good trade right here. It would have been a good trade. But should I get in? Well, no, not according to the strategy, because it did not pull back enough for me. And, you always want, even if you're a discretionary trader, you always want to have, some systematic way of deciding criteria. If you don't have a systematic way of trading, then, it could be very haphazard. So you're thinking, should I get into this trade? Should I not? Well, you should have your rules, but at the same time, you should have your, you should have your discretion. So both of them put together, but you need to have some concrete rules to guide you in your trade. So in this case, yes, in hindsight, this would have been a great trade, an okay trade, but it did not do what I wanted to do, which was pull back the line, pull back to the 100 period or more. In this case, it does. Okay, over here. And this was not that great a trade initially. If you take a look here, correct order moving averages, it pulls back to more than 100 period simple moving average. Okay, it goes down to below overbought, and then it crosses up above there. At that point, I could get into that trade. Okay, get into that long trade. But what does it do? It goes down. Does it hit my stop loss? No, it does not. Will you have times where it does hit your stop loss and then take off in the direction of the trade? Absolutely yes. Okay, and that's why you need to be able to accept your losses and move with it, because those times that when you actually make money on this, will hopefully, overshadow any of the small losses that you take. Okay. That's why you want to have a good reward to risk ratio. Okay. So, you get in on this trade. and then it goes against you. It does not hit your stop loss. You have your stop loss below the last low, okay, but then it takes off in your direction, okay? Maybe that's gets you out at break even. Maybe that gets you out at your reward to risk, at your profit target, depending on how you manage the trade, okay? So same type of thing there. This is Aussie dollar hourly chart, recent price action. You see over here, I have a few things here. This is where it was not so good. See, you take a look here, correct order moving averages for an uptrend here. Okay, it pulls back to the 100 period. You get in right around here, place your stop loss there. It takes you out. Okay, it takes you out of that trade, and then it goes further down. Okay, now here's another one where if you take a look here, you have correct order at this point. Okay, if you take a look, correct order moving averages, it moves to the 100 period, and then it crosses below. You get into that trade. You have your stop loss there. It's it's very frustrating in the beginning. It's a bunch of consolidation. Okay, eventually, if you stay in the trade, it should go in your direction and hit your profit target. But you're not always going to have clean trades like you will here. So over here, you take a look over here. Correct order moving averages to the downside. We see the cross here. That cross occurs right here. We put our stop loss up here. We have our defined risk. We define our our reward, and it hits our reward at some point here as well. This is a very, very good one. You take a look here. Very nice. Correct order moving averages. Price action. Okay, you could say that doesn't really hit, but that's pretty close to hitting that 100-period simple moving average. And we see it cross down here, and that would have been a very nice trade right there. Okay, last one, let me see. Okay, pound dollar, same type of thing here. Okay, correct order moving averages for a downtrend across. Now, again, if it's a huge candle, and you could define a huge candle by however you want to define it on the specific time frame you're using. But if there's a huge candle, okay, then at that point, if your risk reward is skewed, then at that point you might decide not to take the trade. But here we have a cross below. Correct order moving averages goes well beyond the 100-period simple moving average. You get in right around here after that cross and close below overbought. You go in short. You have your defined risk. You have your defined reward. And that would have been a good trade as well. Okay. Here, same thing. This is not such a good trade. Okay. Maybe it did not hit your reward to risk ratio. The direction is correct, but depending upon your how you manage your trade, you could get out at break even. You could be making some money. You could get stopped out. So the main point of all of this, is that I wanted to illustrate that a simple strategy like this can work if you are able to balance your, make your expectancy positive. Now, I talk a lot about expectancy. Let me go to that real quick. Very quickly before I do that, position sizing and profit. One second. Let me go back to this real quick. Okay, position sizing and take profit. As I mentioned, you can put your stop loss right above below the last swing high or low. You can measure the number of pips from entry to the stop loss, and that's your risk, okay? Then you size your trading position so that the dollar amount of your risk does not exceed 2% of your overall trading equity. And that's what I like to stick by, okay? Then you can set your overall profit target at 2 or 3 times your risk, okay? And optionally, let's say this is another way I do it. At 1 time your risk when you're in profit, you could bring your stop loss to break even. At 2 times, you could bring your stop loss to 1 times your risk, and at 2.5 times profit, you could bring your stop loss to 2 times risk, etc. Okay. You could also enter trades with 3 positions and stagger exits. I'm running out of time here. That's why I'm speaking so quickly. Okay. Now, very quickly about establishing expectancy. Now, I just wanted to illustrate here that any strategy that you have, however simple it is, however complex it is, and for me, simple is better, but whatever type of strategy you have, what you want to be able to do is you want to be able to quantify your expectancy. Okay, and here's a simple formula for doing that. And if you want these slides, once again, you could email me at jchen@fxdd.com. Now, when I talk about establishing expectancy, what I mean is you need to have a trade journal on any particular strategy that you're using, and over time, you can see your average winning trade, your average losing trade, and your percentage win ratio. So as I said, you have to balance your reward to risk ratio and your percentage win ratio, and once you could do that, along with a winning strategy, then you could be absolutely consistently profitable if you could do all of that, okay? Now, whatever strategy you're using, you know, a simple strategy like this, a moving average crossover strategy, a very, very complex strategy, whatever strategy you use, you want to be able to establish a high positive expectancy. And once you can do that, then once again, you can be consistently profitable. So that's one of the strategies that I use, and I presented my approach, which is the trend pullback breakout approach, and hopefully you guys got something out of that. I will be, and I have a bunch of tools here that I don't have time to go through, but I will be doing another webinar at FX Street in December, in mid to late December, almost Christmas time. So hopefully you could all attend that, and I'll give you some more on my strategies and approaches to trading the forex market. So I hopefully everyone had got something out of this webinar. And any questions or a copy of the PowerPoint, please email me at jchen@fxdd.com. And thank you very much, everyone, for your time today.